Today, we're unpacking the absolute paradox surrounding Adobe's stock right now. Seriously, if you want a masterclass on how to evaluate high-growth companies while they're caught in the middle of a chaotic market transition, you are in the exact right place. We're looking at a company that is splitting Wall Street right down the middle, and figuring out who's actually right here could completely change how you view legacy tech investments.
So we kind of have to start with a very simple question. Why on earth is a global software monopoly with such deeply entrenched products suddenly the center of so much anxiety and division? I mean, we're talking about the company behind Photoshop, Illustrator, Acrobat, tools that literally built the visual internet as we know it. And yet, the market is treating them like they're on the absolute brink of obsolescence.
And the panic? It's incredibly real. Adobe stock plummeted roughly 30% year-to-date in early 2026. We basically watched the stock fall from its pandemic-era highs of nearly $690 a share all the way down to the $225 to $250 range. That is a brutal contraction. It bled out billions upon billions in market capitalization, leaving long-term holders pretty shell-shocked.
But here is the massive paradox. Juxtaposed against that brutal 30% drop is a record-breaking $6.4 billion in Q1 2026 revenue. They didn't just beat analyst estimates, they posted double-digit earnings per share growth, up 19% year over year. Think about that for a second. That 19% EPS growth means Adobe is piling up unprecedented cash reserves and expanding their balance sheet at the exact moment the market claims they're dying. The company is literally making more cash than ever, but the stock is falling out of the sky.
To make sense of all this, here's our agenda for today. First, the core subscription engine. Second, the AI bear case. Third, inside the financial fortress. Fourth, Adobe's AI counteroffensive. And finally, valuation and 2027 forecasts.
Let's kick things off with Section 1, the core subscription engine.
Okay, so Adobe generates over 90% of its revenue from incredibly sticky, subscription-based segments. First up is digital media, which houses the legendary Creative Cloud and Document Cloud, and that makes up over 70% of the revenue. These aren't just nice-to-haves, these are essential, non-negotiable daily workflows for global creatives and document managers. Then, there's digital experience for enterprise marketers, which handles vast customer journeys and complex data analytics. You see, this isn't just software sold in a box anymore. This is recurring, predictable, deeply integrated enterprise revenue that major corporations simply cannot turn off without grinding their own operations to a complete halt.
Now, the absolute most stunning metric of this entire engine, an 89.4% gross margin. I really want you to think about that math for a second. For every single dollar a customer pays Adobe, it costs the company roughly 10.5 cents to actually deliver the cloud software. The entire rest of that dollar is gross profit. This is the ultimate power of a software monopoly. Once the code is written, scaling it to millions of users globally costs almost nothing. It's a level of underlying profitability that most companies can literally only dream of.
Moving right along to Section 2, the AI bear case.
So, the bear case really centers on this perfect storm of threats hitting in 2025 and 2026. First off, legendary CEO Shantanu Narayan announced he's stepping down, which creates a massive leadership vacuum at pretty much the worst possible time. Second, annual recurring revenue growth decelerated to 10.9%, deeply spooking investors who are accustomed to high teens growth. Third, we are seeing a brutal onslaught of cheaper AI-native competitors. You've got Figma relentlessly attacking UI design, Canva completely democratizing marketing assets for non-professionals, and Google Gemini generating raw media at blinding speeds. To fight back, Adobe is aggressively pushing freemium models. And sure, while this captures tens of millions of new users at the top of the funnel, it heavily dampens short-term revenue. This is triggering massive PE multiple compression. It's what analysts are dreading as Adobe's quote-unquote Meta 2022 moment.
And to make matters worse, Adobe is facing massive internal cannibalization. We are quite literally looking at the collapse of its traditional stock image business. I mean, why would an enterprise pay for an Adobe stock photo when their marketing team can just use generative AI to instantly create the exact custom image they need, perfectly lit and stylized, for essentially free? That highly profitable legacy business is taking a huge hit right now, which is noticeably dragging down overall growth numbers and terrifying institutional investors.
But hey, let's look at the other side. Section 3, inside the financial fortress.
Adobe's board recently pulled out the big guns, authorizing a staggering $25 billion stock repurchase program, running through 2030. This is an incredibly aggressive move to defend its valuation. They are taking the massive free cash flow they generate, nearly $3 billion in Q1 alone,
and using it to relentlessly buy their own stock back on the open market.
This is honestly financial engineering at its absolute finest. Here's how it works. Step 1. Generate massive free cash flow. Step 2. Aggressively buy shares on the open market. Step 3. Permanently retire those shares, which drastically shrinks the total supply. And Step 4. Because that massive profit pie is now divided among significantly fewer slices, the earnings per share and intrinsic value for every remaining shareholder mathematically increases. They are literally forcing the value of the stock up from the inside out, leveraging their fortress balance sheet against the short sellers.
Now let's talk strategy. Section 4. Adobe's AI counteroffensive.
Because Adobe isn't just taking this lying down. Their secret weapon against all these agile AI startups? Corporate indemnification. Adobe guarantees legal safety for enterprise clients using their Firefly AI platform. Since Adobe trained its AI models entirely on licensed and out-of-copyright imagery, they take on all the copyright liability. If a major brand gets sued for using an AI-generated image made with Firefly, Adobe pays the legal bills. You really cannot overstate how huge this is. A Fortune 500 company will gladly pay Adobe's premium subscription prices just to be shielded from rogue AI copyright lawsuits. It completely changes the entire value proposition.
Which brings us to Section 5, Valuation and 2027 Forecasts.
Let's bring in the PEG ratio, that's price to earnings growth, to see how Adobe stacks up against its peers. Right now, Adobe is trading at drastically compressed forward PE multiples, somewhere near 10x to 13x. For a little context, the broader software as a service sector average is up around 40x. Now yes, those peers average 21% EPS growth while Adobe has slowed to roughly 12% or 13%. But even when you factor in that slower growth, paying 13 times earnings for a deeply entrenched near monopoly with 89% gross margins is just absurd. That's a valuation multiple usually reserved for declining Rust Belt industrial companies, not elite cash-gushing tech platforms with global distribution.
So what's causing this severe disconnect? Well, the market is basically acting as a super aggressive, forward-looking discounting mechanism right now. Wall Street isn't looking at the $6.4 billion Adobe made today. They are entirely pricing in the fear that open-source AI will utterly destroy Adobe's pricing power 3 years from now. They're ignoring Adobe's immediate, massive profitability and their M&A expansion, like the pending SEMrush acquisition to bolster their marketing suite. The fear of tomorrow is just completely overshadowing the undeniable cash of today.
Let's actually look at some use case scenarios, forecasting out to 2027. If we look at analysts' conservative models, the low case assumes AI monetization is incredibly slow and valuation multiples stay permanently compressed, yielding a 1.3% annual return. The mid case sees steady AI scaling across their document and creative clouds, yielding around 6.3%. But the high case, where Firefly enterprise adoption deeply dominates corporate workflows and those massive stock buybacks take full effect, projects over 11% annualized returns. Notice something there? Even the most pessimistic, lowest case model still projects positive returns. For a detailed investor, that is the very definition of a strong margin of safety.
So, what's the verdict? Ultimately, the next few years will determine exactly what Adobe really is. Is it a legacy dinosaur slowly being bled out by nimble AI startups offering good enough tools for free? Or is it a drastically mispriced cash machine using corporate indemnification and deep enterprise integration to successfully defend its empire? Keep a very, very close eye on their quarterly ARR growth and Firefly adoption metrics because those numbers are going to tell the true story. Before we wrap up, just a quick reminder that this explainer is strictly for educational purposes. It is not investment advice, and you should always conduct your own deep research before investing in any company. But I will leave you with this one final thought. If the AI revolution is supposed to destroy legacy software, why is Adobe generating more cash right now than at any point in its entire history? Thanks so much for joining me on this deep dive, and keep learning.